break highs few years later. Okay, so I believe that it should be able to achieve that within the next 1 or 2 years. I think right now people are kind of like don't really care about COVID anymore. Right? It's very unlike the conversation say 2 years ago. People were still quite concerned about it, but now people talk about where should we go, how do we plan our travel. People don't care about wearing masks. Majority of people don't wear masks nowadays in public. So I think the effects of COVID has really gone away pretty much. Of course, barring any other issues, any other potential outbreak of pandemics in the future that could, of course, hurt tourism again. But we should be positive, right, and optimistic about the future rather than painting a very pessimistic picture out of it. So, touch wood, I don't think that we're going to suffer another pandemic in the near future, right? Which means within the next 5 years. Given that SARS happened in around 2004. Then about 17 years later, right, COVID struck. So maybe, you must wait at least a decade before we see another scary pandemic that comes out. Okay, that of course always there's a possibility, but I just think that the chances are lower, right, in the next few years compared to say if we have not had a pandemic attack for a long time. Right, so it should look rosy for tourism. And when we talk about air travel, SIA, our national carrier, is at 79% of pre-COVID numbers, right? And they did well. Later I'll show you some of their performances in terms of financial results. So recovery has started since 2 years ago, right? You can see from Q1 FY21-22, the passenger, especially the blue one, right? Look at the blue bar. That's the pax capacity. Cargo is, of course, the non-human part of it. And the cargo is important during the COVID period. They actually put more resources in cargo, right? And now it's the other way around. They need to put more resources to sending passengers overseas. And you can see the blue bar is growing and recovering very well. Almost every quarter, there's actually it's not almost, every quarter there's a quarter-on-quarter growth. Okay, so that is how it has recovered, but yet there's still about 21% from the pre-COVID potential. Okay, so these are the numbers. If we compare SIA pre-COVID figures, right, which is 3Q 2020, they made about $4.5 billion in terms of revenue. Okay, so this is revenue. And in the last quarter, 3Q 22-23, it made 4.8 billion. So the funny thing is that despite the passengers load, right, has not recovered to pre-COVID numbers, but the revenue has already surpassed the pre-COVID high. So that's why I said that SIA share price have done pretty well, right? And of course, recently it has started to come down, but since COVID, it has really went up quite a fair bit, right? So this is because the financial results were indeed good. And if we can understand that the revenue, right, the record high was not contributed by the passenger number, it is then largely driven by price increase. Okay, not passenger numbers, because there's still a 20% to pre-COVID numbers. And there is a lot of pent-up demand. I don't know about you, I do see a lot of my peers, a lot of my relatives, friends, they are out traveling, posting their photos on Facebook, on social media. So the frequency of travel has really gone up, and people are willing to even pay up for the tickets. And that's where I think airlines like SIA benefited, right? Because they managed to charge higher price, and yet they were able to get the bookings. I was just checking a flight, right? I wanted to go to Manchester to watch a football match. And like a month later, okay, it costs around 4,000 Sing to and fro. Okay, a ticket. So I think it's a bit overpriced, right? But that is how SIA has managed to maximize their profit by pushing up the prices and compensate for the passenger numbers, right, which have yet to recover to pre-COVID numbers. Okay, so that is the picture that we can see over here. So there is still some capacity to recover. And that I believe that the passenger numbers will continue and eventually would surpass the pre-COVID numbers. and it's just a matter of time, basically. But I don't think in terms of the share price recovery, is pretty much done already. Okay, so that's my personal point of view, right? Because I think that a lot of people can see this as a trade, because airline is likely to recover, and given that SIA has been breaking record revenue and profits, it is easy for other investors to see and jump into the trade. So I think it's a little bit too late now in terms of for the SIA stock. But as a dividend stock, I think it makes sense, right? Given that the dividend yield is at 5.6%, barring any economic slowdown, severe recession, as well as potential pandemics. Other than that, I think SIA should be able to maintain its revenue and profitability, right? Growth may not be as much, because I believe that as the passenger numbers come back, as the pent-up demand gets satisfied, the prices would not be able to stay high forever. Right, so if the prices come down, passengers numbers go up, it may moderate, right? It may make the revenue stable, it may make the profit stable. So that makes it more like a dividend stock than whether you want to buy for value, whether you buy for growth. I don't think that is the angle that I will go in with for SIA, right? It has the characteristics more like a dividend stock, okay, at this point in time. So next we move to Thailand, right? And the reason is because there's a very interesting stock to talk about when it comes to air travel. Because when you want to play the air travel rebound, it's not just the airlines, but also airports. Okay. Too bad Singapore Changi Airport is not listed, right? CAG is not listed, and there's no way we can invest in Changi Airport Group. But in Thailand, which is one of the most popular places for tourists, has an airport stock that is listed. So which means investors can buy it directly and benefit from the air travel rebound. And relatively, I would always prefer to buy an airport than airline. Why? Because for airlines, the capex is very high, because every plane is very expensive. The maintenance, the engineering, the crew to support the operations is a very capital and operating intensive kind of business. And it's also cyclical in nature, right? Good times, then they can make a lot, but bad times, it can suffer a very big impact as well. So there are good and bad feast and famine periods for airlines, which I don't think it is very good for that kind of stability, right? So for airlines, usually you want to really trade it well, right? Like recovery phase, you want to buy low and you want to sell high. I think that's definitely possible. But as a buy and hold stock may not be as good as other kind of alternatives, right? Airports, on the other hand, yes, they also have cycles, right? If they impact airlines, they will definitely impact airports as well. But the difference is that for airports, right, they're essentially a real estate company, a very lucrative real estate company. Every inch of the airport can make money, right, which I will explain to you later. And airports doesn't have as high capex as an airline, right? So I don't think their cost structure is that as intensive. So during bad years, they don't suffer as much, right? Even though they suffer, but they don't suffer as much as the airlines. So that is why I do think that airports generally make a better business than airlines. Of course, some investors may always prefer the airlines because they tend to be more branded. Yeah, but I don't go by brands. I go by the type of business that is running. So for Thailand, the passengers has also yet to recover to pre-COVID numbers. And these are the past few years. You can see past 5 years, right? 2023, just take note of the color code. Then you can see the lines. 2019 is the pre-COVID one, which is the light purple one, right? This is the pre-COVID line. Okay. And this bright purple is the current FY. So you can see there's still a gap from the pre-COVID numbers, but definitely better than the past few years. Okay, so likewise, I believe that eventually this bright purple line will surpass the pre-COVID numbers. It's just a matter of time, although I don't exactly know when is the crossover point, but I have the faith that eventually it will, okay, because of rising income, declining air ticket prices due to more budget airlines, right? That will increase passenger movements. Okay, so a combination of that factors. And this airport of Thailand is the world's largest airport stock by market cap. Okay, so it's not a small company. Actually, it's a very successful company, and it has 39 airports in Thailand. And the major airports, if you fly to Thailand, it is very likely you will end up in Suvarnabhumi or Dom Mueang. Right, these are the two Bangkok international airports, and AOT owns both of them. And you can see that in terms of passenger capacity, these two have about 75%, contribute to 75% of passenger capacity for the AOT portfolio. The rest of the airports are rather small and for domestic, whereas the AOT airports are the bigger ones. All right. There are some airports that don't belong to AOT. Okay. Belong to Department of Airports, I think, and Bangkok Airways. But the major ones, which are these two airports, belong to AOT, which is more than enough for investors. This is the revenue breakdown. This is what I mean by airport can make money from every inch of the real estate they have. First is that when an aircraft land and park at the airport, it charges the airlines. Second, the moment you exit from the airport, when you fly off from Bangkok, you will need to pay this departure passenger service. This is the airport tax now, essentially. Okay, collects from everyone. And aircraft servicing, right? All the engineering services, refilling, checking of staff, rental of office. Okay, service revenue is like the counter staff. Okay, some of the baggage handlers, right? So if you go to counter, you check in. That's part of service revenue. Concession revenue, this is like the rental plus revenue or even profit share from duty-free outlets or some of the F&B outlets. Okay, so you can see almost every inch of the airport, they can make money of it. So that's how lucrative an airport business is. And I want to highlight for this AOT, right, the main recovery will come from this departure passenger service, okay, which is the airport tax. Okay, obviously, if more people come through, right, if the passenger movement goes up, the tax will increase, right? This is for sure because everybody has to pay it, and you have push more hit counts past the airport, you increase the revenue. All right. Why do I say that's a significant part? Because before COVID, this airport departure passenger service charges, right, is almost half of the revenue for AOT. You can see in FY18 and 19, it's almost half, 42.7, 42.6, thereabout. Okay, but in FY 2022, it's only 32%. So there's another good like 15% revenue that's missing, that's coming from this component. Okay, so this is the key revenue driver which have yet to recover to its full potential. Right, and it's not difficult to understand because the more people you can put it through, the more revenue they will collect. It's just a matter of time. So that is the biggest recovery play that it needs to come. And looking at their financial figures is actually quite a good business. Why do I say that? If you look at their ROA or ROE, right? If we see airport business as a real estate company, okay, a special real estate company, looking at their ROA, they are in double digit, their ROE in double digit percentages, right? These are unlike a typical real estate company. A real estate company ROA is typically less than 5%. Okay, because the asset value is very high, valuation is very high, then the rental is just a fraction of the valuation, right? Usually it's not double digit, but an airport can get a double digit ROA. And of course, if you gear up a bit more, your ROE will go up. Okay, that difference is just the gearing. All right. And come 2020, you can see it plunged to single digit, and then they lost money for 2 years, okay, because there's really not enough people flying. But then in March this year, they started to turn positive again. So there is a lot of room to recover to the pre-COVID profitability, okay, as you can see, right? So all ties in together, the tax must come in, right? The tax revenue must come in. The departure passenger services charges must come in. Okay, then they will go back to this kind of figures. Right? Of course, even though I say that this is the main revenue driver, right? This departure passenger service, but the rest will also increase in tandem as more people come in. Okay, especially those that has related to volume. right? Maybe office rental, no lah, right? But the rest, yes, okay? Because there'll be more aircraft that need to land and park. There'll be more aircraft that need maintenance and servicing. There'll be more counter services that's required. There will also be higher revenue and profits from all the outlets in the airport itself. Okay, so everything will rise in tandem. Okay, so these are some of the positives. And so there are some room for recovery. Domestic flight is only 80% of pre-COVID. International is 70% of pre-COVID. And one of the key reasons is because the Chinese tourists have yet to come back in force. Okay, so this was generally my sensing when I heard from the Thai counterpart, right? When they look at the tourism side, they were hoping that the Chinese come back. So you can see that how critical the Chinese tourism are, because they really have a lot of people, right? And before COVID, they really travel around the world a lot more frequently and in larger numbers. And after COVID, they haven't really get out of the country, right? The thing is that in China, the domestic travel has recovered fully already. Okay, so the Chinese have been traveling, but they've been traveling within China, not outside of China. Of course, they are gradually coming back. Even in Singapore, you start to see more people, in the malls, in the tourist attraction places, and it's just a matter of time again, right? But it's definitely a bit slower and below expectation. Okay, so even countries like Thailand is waiting for China to come back to them. There are some expansion as well, right? Not just going back to pre-COVID, okay, because they also want to expand the business. There will be new airports. There will be more capacity expansion, which means they can accommodate more planes and more tourists, and that will increase revenue as well. And they want to double the passenger handling capacity of 110 million annual passengers to cover over 200 million in the next 5 years. Okay, so they are not resting on their laurels, right? Even though the tourism numbers are recovering, but they're anticipating that there will be growth that's coming in the tourism sector. So that's why I'm saying that it is not enough for tourism to just recover back to COVID number. It must surpass, right? The growth must come back in order to firmly say that COVID impact is totally over. Okay, so that is what this company should aim for. And in terms of their share price, they have not recovered back to pre-COVID highs, right? But they are also recovered quite substantial already. Okay, they are only 8% below pre-COVID high. So I think the mid definitely is not as much, but okay, given all the growth and expansion and all the potential for that COVID recovery, I think that it's just a matter of time that the share price will recover above the COVID high as well. All right. So that is definitely, compared to SIA, I think AOT at this point in time looks like a more relatively better play for air travel. So you don't need to buy in Thailand, right? There is this AOT SDR. SDR stands for Singapore Depository Receipt, just like the ADR in the US, American Depository Receipt. And you can, because they're traded on SGX, you can buy and sell normally as any other SGX listed securities. And this AOT is traded in Sing dollar as well, so you don't need to convert to Thai baht. It will just track the underlying and then they convert to Sing dollar for you. And this is the ticker, should you be interested, it's TATD. Okay. Right, next, let's move to the hotel segment. All right, this is the Singapore Hotel Revenue Per Available Room, or RevPAR in short. So how to get this number is just the average price, average room rate, and then you multiply by the occupancy rate. Okay, so then you get this revenue per available room. So that is to measure the typical earnings of a company, of a hotel per room, basically. Okay, so this is the pre-COVID numbers, right? And this is the post-COVID numbers. You can see that the revenue per available room has already surpassed the pre-COVID numbers. So which means hotel stocks should be doing very well, right? So that is the picture that we can see from here. And the reason is because the occupancy rate has moved back to pre-COVID numbers. I think it's like more than 80% occupied on an average night. And prices has also gone up. That's why the revenue per room has also gone up. Okay, so that is the picture for hotel. So it's a good thing for hospitality in Singapore. All right. And these are the Singapore hotel stocks. And what I wanted to find out, right, I tabulated this because my sensing was that the recovery for hotel wasn't uniform. Okay, this table that we saw, or this chart that we see here, is only about Singapore hotels, right? It's not hotels in Thailand, it's not hotel in Malaysia, it's not hotel in Indonesia, it's not hotel in Hong Kong, China, Europe, US. Okay, this is just Singapore. And my sensing is that it is only that the Singapore hotel stocks are doing well. And this table actually reinforced my assumption. Right? Why? Because you look at Far East H Trust, which has 100% of their revenue coming from Singapore hotels, their share price have performed the best. Right? It has recovered quite significantly in the past 5 years, 3 years. So if their 5-year performance, right, is positive, right, that means they are already surpassed pre-COVID period already. Okay, so that is how you can read this. And for year-to-date performance is just this year. And so you can see Far East H Trust and Amara has the highest percentage in terms of deriving their revenue from Singapore hotels, and they are also the ones that showed good share price rebound as well, right? So that is the difference. The rest is a mixed bag, okay? Like HBL, yes, they don't have a lot of Singapore revenue, just 31%, but they did well, okay? Bondvest as well, all right? But some of them, like Bondvest, they don't just do hotels. Okay, so they also have investment properties like Liat Towers. They have like refuse garbage truck business called can't remember the name already. It used to be listed, okay, but they delisted it and parked it under as a wholly owned subsidiary of Bondvest. So they have more business than that, but the rest are mainly really in hospitality business. Okay, Banyan Tree also shown a bit of recovery here. But past 5 years, you can see most of them are actually negative, right? And it's clearer that the Singapore heavy hotel stocks are doing much better than the rest. I guess it's also because the rest of the world may not have recovered in terms of the revenue per available room like Singapore had. Okay, so market is pricing some of these laggards accordingly. So this is Far East H Trust property. You can see that they are quite, they're all in Singapore basically, right? And I believe you've seen some of them before. And they are in quite touristy places. So that's probably why they have managed to recover a lot better than the rest. And that said, their dividend has not fully recovered yet. Okay, the pre-COVID numbers, FY 2019 is 3.81 cents. Right? Last FY they were doing at 3.27 cents, and this year first half is 1.92. If they can maintain the second half at the same rate, then they will beat the number, right? You were 3.84, right? Really surpass. Okay, so this is the year that they are really able to fully surpass the pre-COVID dividend. So you can see that the Singapore hotels have fully recovered. Right. Maybe not all, okay, we cannot say all, but at least for Far East H Trust is a good example. And which means that since that Far East H Trust, right, the share price are already gone up okay, beyond the pre-COVID numbers. It may be a bit too late, right? But unless you're okay with the dividend yield, okay, then maybe you know, if you look at a 6% dividend yield, then you're okay with that, it's still fine. Right? But in terms of price recovery, maybe there isn't much meat anymore. And for the other consideration would be like Bondvest, right? Bondvest doesn't have a lot of hotels, right? Because it actually it has a lot of hotels, just that they have other businesses. Okay, but I think that is undervalued. Their key hotel in Singapore is Sheraton Towers, right? They have quite a handful of hotels in very exotic places, like I don't know, Zanzibar, you know, those kind of honeymoon getaway kind of location elsewhere. Okay, probably those hotels haven't really recovered, right? But the Sheraton Towers, if we talk about Singapore-based, it should have probably reached its peak running numbers. And they also have like Liat Towers, which is in Orchard Road at a very premium junction, right, of Orchard Road, just opposite Ion Orchard. And with tourism coming back, the retail side should also do well. And we talk about some other business that they have, right? The garbage truck business, which is actually quite a profitable business. That's why they listed it. So all in all, may not be a bad consideration, right? If the recovery is still ongoing, they are a laggard at the moment, right? Because their share price have not recovered past the past 5 years, but in the recent year to date as well as 3-year performance, there is some recovery. Okay, so which means that there is some momentum in terms of the share price recovery. There may be some more meat for Bondvest itself, right? Okay, so this is what the share price look like. You can see past 5 years, it has not recovered back to the pre-COVID numbers. So there is some room, right? There is some room. Okay, Genting Singapore. This is an obvious beneficiary of tourism and COVID recovery, right? It's one of the 2 integrated resorts in Singapore, and they, with more tourists, more revenue spent at the integrated resort, whether it's Universal Studios, whether it's the restaurants, the merchandise, hotels, right? So they have a lot, and even casinos. Okay, don't forget about that most lucrative part of the IR. So Genting is a place where it is under the entertainment segment. Okay, so their first half of this year, their result has been fantastic, right? You can see the recovery from compared to just 1 year ago. Over the same period, the revenue has gone up 63%. So it crossed $1 billion revenue for the first half of this year, and net profit has also more than doubled. Okay, I'm not sure whether you know, something that was very impressive about Genting was that during the COVID period, when really there was no tourists, right? Okay, only really surviving on locals, they still managed to give dividends. They have never stopped dividend throughout the COVID period. Okay, as a tourism dependent stock, they were still able to do it. I think is very commendable. Okay, so that is just something extra for you if you do not know about it. Okay, so definitely you can see profitability came back, revenue came back, and we're talking about what, 27% net profit, right? Quite a fat margin. Okay, so they have definitely went past their fixed costs by quite a mile, right? Yet they have yet to recover back to the COVID numbers, pre-COVID numbers. Okay, pre-COVID they were doing 2.5 billion a year. So now first half 2023 they were doing a 1 billion. So if second half they do about 1.1, 1.2 billion, is still below this 2.5 billion. So roughly there is another 25% recovery room, right? Not fully recovered yet. And there's more like they're running more events, like this Halloween theme that's coming back after 3 years of 2 or 3 years that they didn't do it because of COVID. Now it's coming back. Events are coming back. They're also doing some enhancement and expansion, right, to increase more space for to accommodate more tourists, right? More kind of a theme within the Universal Studio, Minion Land, all this, right? Extension here and there. So they are trying to expand as well. Okay, as I said, they must surpass the pre-COVID numbers. Reaching the pre-COVID numbers alone is not enough. This is their share price, right? Share price have gone up and then came down, but it is around the pre-COVID levels. Okay, these are pre-COVID levels, right? Now this is where they are. Okay, so it's about that. Investor probably anticipated the recovery, right? So they have already pushed out the share price. It's not just moderated back to it, and which means the COVID recovery potential has already priced in already, which means that if you really want to get a good entry, I think it has to go lower, right? About 58 to 74 cents. That's my rough gauge of a good undervalued price for Genting. Otherwise, you don't have enough meat, okay, to play this recovery. The next one I want to talk about is the retail sector. Okay, so retail sector, again, I want to zoom into this Thai stock. One of the Thai SDR. This is a CPO. Okay. Again, because for Thailand, it is important. Tourism is very important to their economy, right? And these tourists, when they go there, likely they will also spend more in retail shops, right? Because you need to buy your supply, so-called your water, your drinks, your snacks, And the 7-Eleven in Thailand is a lot more fanciful, a lot more things compared to the Singapore ones. Okay, so you may find a lot more different interesting stuff to buy as well. So CPO owns all the 7-Eleven stores in Thailand, and it's also have two other format. One is a wholesaler, which is Macro. This is more like your Costco in the US, where you buy in bulk at very low price. Okay, and supermarket, Lotus, and they have it in Thailand. They also have some supermarket, Lotus supermarket in Malaysia. So some of you who wish travel to Malaysia, you may have visited CPO and contributed to their revenue. Okay, so these are the three retail format that CPO have. And of course, 7-Eleven is the, later we'll see the key of the whole thing. And Thailand has the largest number of 7-Eleven stores outside of Japan, right? Because 7-Eleven is a Japan company. And in Thailand, surprisingly, despite that it is not the most populous country in the world, even compared to, say, US and China, definitely Thailand is a lot smaller, right? Yet the number of 7-Eleven stores outnumber these big countries, okay? And it has got to do with the style, right? Their lifestyle in Thailand. Because in Thailand, about 33% of the grocery sales, right, is bought through 7-Eleven. It is very different from Singapore, right? We don't really buy grocery from 7-Eleven. It's just unthinkable. But to them, it's very normal, right? In fact, 1/3 of their groceries come from 7-Eleven. The reason is not difficult to understand, right? Because Thailand, is a lot more sparsely populated, right? The country is a lot bigger as compared to Singapore. We may be in proximity to a supermarket, right? In fact, we might have access to like 5 or 6 supermarkets near us within walking distance. But that is a luxury in Thailand. Most of them stay like probably an hour drive away from the nearest supermarket. It doesn't make sense for them to travel all the way. So if they just want to get stuff at small quantity, they may just buy from the nearest convenience store, because it's a lot easier to have this 7-Eleven closer to certain residential area, right? And that's where they can buy some of the groceries from there. And the prices between the 7-Elevens and the supermarket in Thailand is minimal, right? As compared to Singapore, the 7-Eleven here probably mark up a lot more, right? So there are a lot of all these differences. And they also have a lot of product range, right? Like groceries, and they some even have pharmacies, okay? Like our Guardian, Watsons, they have it in the 7-Eleven stores. So it is very convenient for them to buy from these stores, and that is why it is one of the key infrastructure, right, if you can use that word, for the Thailand day-to-day kind of necessity shopping, okay? So, and 7-Eleven is the dominating convenience store in Thailand, about 74% market share, and Lotus Go Fresh 9%, but these two belong to CPO. So which means CPO have 83% market share of convenience stores in Thailand. So it's almost close to a monopoly really. Okay, and yet the Thailand Trade Competition Commission didn't object to some of the mergers, right, which I will mention later. So actually they merged these two, okay? They merged these two, all right? And they also, after they merged these two, they also had a controlling stake in all the supermarket market share in Thailand as well. So they are indeed a dominating player, a dominant player in terms of retailer in Thailand. And this is for their all their stores, okay, whether is it 7-Eleven, Lotus, or Macro. This is the average day sales per store, and they have already surpassed the 2019 figures. Okay, so that's a good sign. The spending is coming back, but the profitability has not slowly coming back. Okay, but this year, last year they haven't really fully recovered, but this year it is likely, right? Why? Because pre-COVID, we can use this number, which is 16 billion baht. Okay, and this quarter one is 4 billion baht, quarter two is 4.4 billion baht. So first half is about 8.5 billion baht. Okay, so assuming 3Q, 4Q, no growth, same, right? And just multiply by 2, you will hit 17 billion baht. Okay, which is already more than 2020 figures. Okay, so it is also very likely that the net profit is going to surpass the previous figures. So that is a good sign, right? Because they also had a merger last year, and they haven't got a synergy yet. Okay, so the synergy is coming in. They can use less staff, less resources to generate more revenue and profits. Okay. So the share price, good news is that it has not recovered back to the COVID numbers. Okay. COVID is here, right? COVID high was above 80 baht per share. Now it's about 60 plus baht per share. Okay. And yet the fundamentals, as you can see, whether is it revenue, whether is it profit, this year they are going to surpass pre-COVID figures. Okay, so fundamentals have recovered, but share price have not. Okay, so there may be some opportunities here. So same thing, this CPO is traded on SGX as a Singapore Depository Receipt, and you can buy and sell as per other SGX listed securities. The ticker is TCPD, and it's traded in Sing dollar as well. Okay. So you all have no question. I don't see any question from you so far. Okay. Feel free to ask. All right. Otherwise, I don't know whether you understand what I'm talking about or whether I'm really so clear about my points. Okay, so in summary, tourism has largely recovered, as we have seen, right? Whether it's the passenger figures, the company revenues, but all of them still have some room to go to pre-COVID figures, about 20%. Of course, there are some cases where they have surpassed the pre-COVID figures, like your 5H Trust, like your CPO. Okay. But majority have yet to, right? They still have some room for that recovery, and it is just a matter of time how fast that recovery is going to come in. And the thing is that not all tourism stocks have also exhibit price recovery, right? So 5H Trust, yes, fundamentals have recovered, revenue have recovered, but then actually 5H Trust, the dividend this year is going to fully recover, but the share price have more than recovered. Whereas for CPO is the opposite, right? So this year their fundamentals are likely to surpass, but their share price have yet to recover. Okay, so for AOT, price and fundamentals have yet to recover. For SIA, price have recovered, but the fundamentals have yet to recover, except for their revenue has exceeded. So you can see it's not very uniform, right? So far, all these tourism-related stock. It is important before you go into any stock that is tourism in nature, really compare to the pre-COVID numbers, fundamentals, share price, all these aspects. Okay, then you get a better sensing whether there's still any much more meat for you to play the recovery. Okay, and today I mentioned some of the stocks, right? And I think that the SIA is more like a dividend stock. I don't think in terms of share price recovery there's any much more because the investors have really bid up the share price in anticipation of recovery, right? It's the most obvious, and yet the fundamentals still have some room to improve. I see it more as a dividend stock. Okay, passengers number should go up, but I don't think the price, the ticket price can maintain. So the ticket price likely have to come down, and volume goes up. So the revenue can maintain, dividends can maintain, right? For AOT, the aspect is more like there's still room for recovery fundamentally, and share price, right, still below pre-COVID levels for the share price. And also there's expansion coming in, and relatively I also shared with you that the airport business is a much better business than the airlines. The ROE is a lot nicer. Capex is not as heavy as well. Then the third one is 5H Trust, the also only for a dividend aspect, right? If you're okay with like 6% yield, it's okay to buy, but don't expect price recovery to come because the share price have really recovered quite substantially. Similar case as SIA. Okay. I also talk about Bonvest, right? Bonvest is an alternative hospitality company plus retail. If you are looking at some of these hotel plays, right? The reason is because the share price have yet to recover. It has some Singapore assets like Sheraton Singapore. It has some hotels overseas. okay, which may not have fundamentally recovered, but as a laggard and very undervalued stock, I think there may be some opportunities there, especially share price have climbed back a little bit for this year so far, as well as from 3 years ago. Okay, so it's slow but gradual. Then lastly, CPO, right? Potentially, it is really quite far, right, from its pre-COVID share price. But fundamentally, in terms of revenue, profit this year, second half of this year, they should be able to break new record. So that may have some catalyst for the stock to recover a lot more compared to some of the others that we've seen today. Okay. I still have about 10 minutes. Any question from you guys? Are you able to type the...
Hey, Alvin. I have some questions on hand for you, just to get the ball rolling. All right, members of the audience, if you would like to send your questions over to Alvin to address, you can type them into the question box, and Alvin will pick them up as we go on. All right, first things first, Alvin. In terms of what you've shared today, I have a two-part question for you. The first one is, what are your top 3 takeaways that we must remember from your sharing today? And every time we talk about SIA, I think a close question that the members of the public would like to know, investing public at least, what about SATS, and what's your view on that?
Okay, 2 questions. So the first question is the big 3 takeaways, right? So I think I said it just now, but no harm repeating it. The first is that don't assume that all the tourism stock will recover uniformly, as we have seen that that's not the case, not just in terms of share price, but in terms of the fundamentals. Some have recovered fully and surpassed, but some have not. So if you're looking at some of these tourism plays, it's important to really look at all these things and compare to the pre-COVID numbers, okay? And the second thing is that, yes, it's important to recover what was lost due to COVID, but it's not enough, right? They still need to grow beyond that pre-COVID figures, and which means that investors also need to look out for potential growth that's coming from these companies. Cannot be just a pure recovery play. It must be something more, right? Are you going to expand? If not, then maybe it might even be a value trap. Okay, because now, because of inflation, right, the operation costs have gone up compared to pre-COVID numbers, right? So even if you have the same revenue, you may not have the same profitability anymore. So you need to grow more in order for you to get an operating leverage. And then the third thing is that one of the useful things that we have seen today is, besides comparing the fundamentals to pre-COVID levels, also compare the share price to pre-COVID levels, right? So if the first 2 is true, okay, the first 2 points I mentioned is true, right? Are true. First, if the fundamentals are going to fully recover, and second, they have room for expansion, that means the third point, if the share price is still below pre-COVID levels, then there is really a good potential play for the price recovery. So if all these 3 fulfill, you might have find a gem in the tourism sector, right? So some of the counters that we have mentioned today, worth a look, like AOT, Bondvest, CPO, all these are potentially having that price recovery potential. Your second question is about SATS, right? So SATS is a little bit trickier. Yes, they will benefit from recovery, and I'm reluctant to put into today's presentation is because the complexity has expanded significantly, okay, because they went to acquire a company that's bigger than themselves. I'm not a fan of M&A, right? Merger and acquisition. And given a very big acquisition like this, bigger than the company, the acquirer, it's like having a very heavy meal, right? And you will suffer for indigestion. Okay, a lot of financial metrics that you have seen, the historical numbers of SATS, operating figures, right, is no longer valid anymore. Okay, because now the combined entity is a monster. Okay, all the historical records is irrelevant, and you really have to monitor it further, right, for the next few quarters at least, if not for next few years, to see whether the new entity is able to perform well All right. Otherwise, it's too early to say, and that's why I don't think SATS is a good counter to look at, because it's really very complex and uncertainty has gone up a lot.
Right, Alvin, we have some questions in the question box. We have one interesting one from Kenny. Kenny is asking, what is the dividend like for Thai SDR, and how much tax will be deducted from dividend? Maybe, it's a good opportunity to share what's the potential opportunity for trading this stock.
Yeah, that's a good question, right? Their dividend yield are not that high. Okay, I think it's about 2-3% kind of yield that you're looking at. A couple of reasons. One is that for AOT case, it's definitely because they're still recovering, right? You can see the profitability has not gone up yet. Okay, CPO has some potential, right? But the dividends probably have not gone back to their pre-COVID numbers yet. But there is potential that they may for at least the second half of this year. So the yield may go up, okay? But to me, the biggest potential for them is not so much of the yield, but more of the price recovery. Okay, because today's the presentation I scope towards more of the cap gains from the price change rather than for the dividend side. So then they will make very good consideration. Then in terms of tax, right, there's a 10% dividend tax for Thai stocks. Okay, so which means that all the AOT, CPO would draw a 10% tax. So which means that again, because of dividend tax, right, it also makes more sense for investors to invest for cap gains for this Thai SDR rather than for the dividend. Because if they give more dividend, means your tax is going to be higher. Okay, but that's it. 10% I think is reasonable. It's not very high, right? Like in US, it's very high. It's 30% dividend taxation. Okay, so I think 10% is still reasonable, but still the potential play is more on the cap gains rather than dividends.
Right, Alvin, we have two questions from Tian Choi. He's asking about Thai BEV, a stock that's closely watched by the local investors, and as well as Escort REIT, and what's REIT looking like in the months to come.
Okay, so for me, I don't view Thai BEV as a tourism-related stock, definitely, right? Because although some may argue that tourism will help with consumption of Thai BEV beers. Okay, more people travel to Thailand.
I think that's the angle we are looking at.
Potentially, yes, right? But we can also argue that their majority of revenue is really through the distribution of their bottled or canned beers, beverages. Also they also bought F&N, right? The non-alcoholic beverages. As well as their Thailand spirits, their hard liquor. I never drank that before. I'll try it one day. But for that case, right, which means it's not really tourism related. It's more of how Thai beverages are seen as more attractive alternatives to other brands. Okay, the problem with beer is that there is a lot of competition. You go to any supermarket, you look at the beer shelf, right? So many of them, and there is no differentiation factor. Right? Okay, I can give you, because I drink quite a lot of beer, so I know. Actually, all alcohol. So when I can tell you do a blind test, right? You never know which brand of beer you're drinking. Okay, so there is no quality difference. There's very little product differentiation, basically. Okay, so end up, right? Beer is based on prices. Okay, of course you may have a favorite brand, right? But otherwise it's boils down to price. I'll get the cheapest beer, okay? Because anyway I can't tell the difference, right? So might as well buy cheapest. Yeah. So when they try on this price war, right, then the margins become thinner and thinner and thinner. Okay, that is the issue. It's not just with beer in Southeast Asia. Beer in China is the same case. Beer in US is the same case. A lot of beer companies have not been doing well. Right? It's not just Thai Bev alone. Of course, they have other non-alcoholic beverages, which is also competitive, right? Because now there's so many alternatives as well. Even the China brands like Nongfu Spring is coming in. There's another one, Yuanqi Shenling from China also coming in. All sorts of places, right? So you have very powerful brands coming in to compete. Then lastly, the Thailand spirit is mainly drank in Thailand, right? It's not drank anywhere else. So it's really depending on the domestic demand. It's not really related to the tourism. So overall, I think it is a difficult business. And also they bought Saigon Beer a few years ago, right? That was also a huge acquisition that they haven't bear fruit. Okay, rumor is that they want to get rid of it already. So you can see M&A again, this failed, right? Or not say fail, not very a rosy outcome. And so I think there is a higher debt that's involved because they borrowed to acquire Saigon, and now interest rate has also gone up. So it's not in a very good situation. So altogether, you put together, they are not in a very good position now, and highly competitive, low margins, and low growth as well. So that's generally my view lah. Okay, beer is a very difficult business. Yeah. As for the second case, Ascott Reed, right? Ascott Reed is not, again, my view is not related to tourism. Although they are like considered service apartments, which tourists can also rent, but usually these Ascott Reed, their customers are corporates. They have clients or hiring companies sending their staff, right, to, let's say, to Singapore to stay 1 month because of certain project, longer term stay. Then they will rent this kind of service apartments or residences. Yeah, other than that, tourism would not impact it so much. So if business travel recovers, which I believe yes, right, but the case is a bit similar to the office side. Okay, if you recall, especially office properties in the US is not doing well. It's terrible right now because people have not really gone back to work, gone back to the office to work. They've gone back to work, but not going to the office. They still prefer to work from home, right? So, and that caused a lot of the office REITs to do very badly. Those that are based in the US. And if we extrapolate that culture, right, to Ascott REIT, it might have some impact. Because if they are not even going to office, right, why would they fly to another country office to work? Unless they really, really, really have to. If you just talk about meeting, can be done over Zoom, can be done over Microsoft Teams, a lot of this software, people are used to it. They don't really need to fly as much as before. Maybe if, I don't know, it's on-site inspection, engineering stuff, then maybe no choice, right? They need to be there. But if it's just really communication, this can be done online. So I do think that office travel may not recover to the pre-COVID numbers, just like US office REITs. Right, so there may be some headwinds over there for Ascott Reed as well. And not forgetting that all REITs right now are also facing interest rate risk due to the higher for longer. Okay, that's a new theme, right? Interest rate may not go up so much because they likely hit a peak, but they are going to stay higher, which means the rate cuts may not come so soon. So REITs will have to bear higher financing charges going forward. And if you take a look, a lot of REITs that have very high gearing, those close to 50% gearing, right, are in jeopardy. Okay, their share price have come down significantly. And investors are really, really very concerned about gearing ratio now than ever before. Last time nobody cared because interest rate is very low. Now everybody cares because gearing ratio is the interest rate is high, and if the valuation drop, right, there's a chance that they will bust that 50% limit. So that is the risk with REITs in general, right? Not Ascott REIT only, but every REIT out there. Okay. Hopefully I addressed your question. Thank you for these questions. Otherwise,
all right, thank you so much, Alvin, and thank you for your valuable insights. I'm likely to listen to this webinar once more as I take my next train ride and try and take in all the insights that you shared today. All right, members of the audience, if you have more questions, you can send them in our survey form at the end of the webinar. And thank you once again for being a wonderful audience, and we'll send you a link to this video so you can catch up on the insights and be updated of our upcoming webinars as well. Once again, Alvin, thank you so much. and have a lovely night ahead.
Thank you. Thank you, Philip Nova. Thank you, Sri. Good night.